Picture a giant airline, hundreds of aircraft, thousands of shops if it's a retailer, billions of euros of assets it uses every single day. That, for decades, barely showed up on its balance sheet at all. How? One little word: rented. Here's the staggering part. Across the world, companies were using around $3.3 trillion of leased assets, and less than 15% of it sat on their balance sheets. The rest was invisible debt, hiding in plain sight. IFRS 16 is the standard that dragged it all into the light. Stick with me. By the end, you'll read a balance sheet like an x-ray. So how was it hidden? The old rule book, I as 17, split leases into two boxes. A finance lease, where you effectively own the asset, went on the balance sheet, but an operating lease, a plain rental, stayed off it entirely, just a rent expense each year. And guess which box companies preferred? The off-balance sheet one. Sign a 10-year lease on a fleet or a store network. Call it operating, and your debt looked tiny, even though you were locked in for billions. Two airlines could have identical fleets, one that bought, one that leased, and look completely different on paper. Investors were flying blind. IFRS 16 is the fix. So, what is IFRS 16? It replaces IAS 17 and took effect from the 1st of January 2019. And it does one bold thing. For the company renting the asset, the lessee, it deletes the operating versus finance distinction entirely. One single model. Almost every lease now goes on the balance sheet as an asset you control and a liability you owe. No more hiding. Lessors, the owners renting out, keep the old two-way split. This story is about the lessee. Part 1. Bringing the lease onto the balance sheet. Asset and liability, side by side. First, is it even a lease? IFRS 16 gives a sharp test, absorbing the old IFRIC 4 guidance. You have a lease if you control the use of an identified asset for a period in exchange for payment. Control means two things. You get substantially all the economic benefits from using it, and you direct how it's used. A specific floor of a building for 5 years? Lease. A short stay in any hotel room? Not a lease. That test decides everything. Once it's a lease, you record two things. Take a simple example. A 3-year lease, 10,000 euros a year, paid in arrears at a 5% borrowing rate. The lease liability isn't the 30,000 of total payments. It's what those payments are worth today, discounted at 5%. Discount them and you get 27,232 euros. That's your lease liability on day one. And your right of use asset starts at exactly the same value. Quick pause on that phrase. A right of use asset sounds abstract. It just means your right to use that asset, the aircraft, the shop, the machine, for the lease term. You don't own it, but you control it, so you show it as an asset. And lease liability is simply the flip side. Your obligation to make the lease payments, measured at present value. Right to use on one side, obligation to pay on the other. Two sides of the same coin. So the day one journal is beautifully simple. Debit right of use asset, 27,232. Credit lease liability, the same amount. In one entry, an asset and a liability that were completely invisible under the old rules appear on the balance sheet. That's the whole revolution in a single line. Now watch what happens each year, because this is where people get caught out. The old rent expense of 10,000 a year is gone. It's replaced by two separate costs. One, the asset depreciates, usually straight line, 27,000 over 3 years, so 9,077 a year. Two, The liability charges interest, 5% of the opening balance, so $1,362 in year one. Add them. Year one cost is $10,439, not a flat $10,000. And because interest is highest early, the total cost is front-loaded. Higher at the start, lower later. Same total over the lease, different shape. Part 2. The balance sheet transformation, the same company before and after. Here's the before and after, side by side. Under IAS 17, our operating lease, no asset, no liability, just a footnote, and $10,000 of rent hitting the income statement each year. The balance sheet stays clean, deceptively clean. Under IFRS 16, the same lease, a right-of-use asset of $27,000 and a lease liability of $27,000, both on the face of the balance sheet. Assets up, debt up. The commitment is finally visible. Nothing about the deal changed. The cash paid is identical. But the picture a reader sees is transformed from an empty balance sheet to one that tells the truth about what the company is on the hook for. And multiply that by the whole market. The IASB found around $3.3 trillion of leases worldwide, with under 15% on balance sheets. IFRS 16 brought roughly $3 trillion of hidden commitments into view. About half of all listed companies were affected. And for the lease-heavy ones, airlines, retailers, shipping, total assets jumped by around 14% overnight. Not because anything changed in reality, but because reality finally showed up in the numbers. Part 3. The sensible exceptions and the fine print that keeps it practical. IFRS 16 isn't heartless. 2 exemptions keep it workable. Short-term leases, 12 months or less, can stay off balance sheet, expensed as you go. And low-value assets, think laptops, office furniture, a printer, the same. So you're not capitalizing a 1-month van hire or a €200 laptop. It's the big, long commitments, the fleets, the stores, the buildings, that IFRS 16 forces onto the balance sheet. A few more threads tie up. The old interpretations, IFRIC 4, on whether an arrangement contains a lease, and SIC 15 and SIC 27, are all folded into that single control test we saw. One rule now, not 4. And one thing that did not change, lessor accounting. If you're the one renting the asset out, you still split leases into finance and operating. IFRS 16 rebuilt the tenant side of the story, not the landlord's. One more update worth knowing. In 2024, IFRS 16 was amended for a tricky case, sale and leaseback, where a company sells an asset and immediately leases it right back. The fix stops the seller booking an inflated gain on the slice of the asset it keeps using. You measure the lease liability so that no gain or loss is recognized on the right of use you retained. A narrow rule, but it closed a real loophole. Part 4, who feels this and what it changes for anyone reading the numbers. Who was hit hardest? Anyone lease-heavy. Airlines with leased fleets, retailers with thousands of store leases, shipping, transport, telecoms, hotels. For some retailers, the new liabilities were so large they rethought store expansion altogether. Getting ready meant find every lease, even the ones buried in service contracts. Gather the terms and discount rates. Build systems to track right-of-use assets and unwind liabilities. Embrace every debt covenant and ratio for the change. And for you, reading the accounts, 3 things move. 1, gearing. New liabilities appear, so debt to equity jumps, even though the business is unchanged. 2, a subtle one that trips people up. EBITDA rises. The old rent expense sat inside operating profit. Now it's split into depreciation and interest, both below EBITDA. So earnings before interest, tax, depreciation look better, without a cent more profit. 3. Comparability. You simply can't compare a post-2019 balance sheet with a pre-2019 one at face value, or a leaser with a buyer without adjusting. The upside? Hidden lease debt is hidden no more. You can finally see the real leverage. There's one more statement IFRS 16 quietly reshapes: the cash flow statement. Under IAS 17, every operating lease payment sat in one place: operating activities. Under IFRS 16, that single payment splits in two. The interest portion stays up near operating, but the principal repayment drops down into financing activities. Not a cent of extra cash leaves the business, yet operating cash flow suddenly looks stronger. One more reason a post-2019 statement doesn't line up with the years before it. So let's bring it home. Control an identified asset, and it's a lease. Put it on a right-of-use asset and a lease liability at present value. Each year, depreciate the asset and unwind the liability with interest. A front-loaded cost. Short-term and low-value leases are exempt. And the whole point? Leases that were invisible are now on the balance sheet in plain sight. That's IFRS 16. The impact in one picture. Before, $3.3 trillion of leases and over 85% of it off the balance sheet, invisible. After IFRS 16, nearly all of it on the balance sheet, visible, comparable. The cash never changed. What changed is that you can finally see the debt that was always there. So let's pull it together. IFRS 16 gives the lessee one model: control an identified asset, and you recognize a right-of-use asset and a lease liability at present value. No more off-balance sheet leases. Each year, the asset depreciates and the liability unwinds with interest, a front-loaded cost. Watch three things in practice. Gearing rises, EBITDA rises without more profit, and pre- and post-2019 numbers just aren't comparable. Master that, and no leased fleet or store network can ever hide from you again. That's IFRS 16, the standard that put $3 trillion back on the balance sheet. Next time, IFRS 18, and how financial statements are being redesigned. See you there.